Thanks so much, Ray. Listen, it's so exciting to hear about the growth that we've had in the Mortgage Center. As you mentioned, the dynamic growth and how important that is for our membership, because as we've grown, it's not just the point of being bigger, it's allowed us to provide more and more options for all of our members. So this is really exciting to hear. Thank you again for the introduction. As Ray said, I've been at the credit union for 19 years. I'm one of many long-term employees at UNFCU, and I think that actually speaks volumes about the credit union as a company, as an employer, and really as a place to do business with. So, I'm very proud to be here today, and we're really thrilled to have you here today. Thank you so much for joining us. And if you joined us yesterday for day one of our virtual financial fair, I hope you found it very helpful, and I really hope that you will today too. As you know, we're going to be talking about home lending and home buying and lending today. Throughout the seminar today, we really would like for you to submit questions to us. Use that Q&A feature at the top of your, or wherever you may find it on your Zoom dashboard. We would love to hear from you, know what your questions are as we're going, and we will save time at the end of this seminar to go over your questions. Sylvia, our host, and I will do a whole Q&A session. Speaking of today's seminar, I'd like to give you a little bit of a summary of what we're going to be reviewing today. First, we're going to talk about the different types of homes that are available for purchase and ownership in the United States. Then we'll talk about how you own those properties. So do you own this property as a primary residence, or as a vacation home, or as an investment property? Next, I'm going to provide for you a brief overview of the entire home buying process. I'd like to do that so that we're all on the same page regarding who is, what various parties involved in this process are going to be, what the steps are, and in what order do they take place, and then also what the entire length of this process is going to be, because it can vary a lot depending on what you buy and where you buy it. We'll touch on some of the basic, and by basic, I mean most important, mortgage lending terms that are used, and you're going to hear these terms a lot. We're going to review the benefits of financing through UNFCU, particularly in relation to our UN members. And of course, as I mentioned, we're going to save time for our Q&A at the end. As you can tell, we've got a lot to cover, so I'm going to be moving pretty quickly. As Sylvia said, all of this information is going to be made available to you. Our marketing team has done a great job in pulling this event together, and they will also do a really good job in sharing this information as we go forward. So let's dive right in. We're going to talk about the three different types of home ownership. And if we could actually jump to the next slide and move forward with 1 to 4 family houses. And so first off, let's talk about a single family residence. This is a house. And ownership of a house is the most basic form of home ownership, of course, in the country. You own the house, you own the land or the lot, the trees, the driveway, the grass, the white picket fence. You can basically do anything you'd like to with your house. I mean, let's keep it legal, folks, but as long as it's within the zoning guidelines for your town or community or municipality, you could do what you'd like to do with a house, meaning you can renovate it, you can make additions, you can paint it, you can put in a pool. You also have the flexibility to rent a single family residence. That's of course important for you and staff members who have concerns about mobility issues and perhaps the need to go away on mission for a year or so. So with this single family residence, you can rent the property out. Since you own this home, you're responsible for all of the maintenance on the property, which makes sense. So if there is a leaky roof, or if your furnace has a problem, or whatever the physical problem for the home may be, you will be responsible for those types of repairs. Now you can see we actually note here 1 to 4 family houses. So we know what a single family residence is. A 2 to 4 family property, typically found in a more urban area, but really could be found anywhere in the country, would be a home where you live in 1 unit and you rent out the remaining 1, 2, or 3 units. Of course, the advantage to having a multifamily property is that you have tenants and you earn rental income on the home that you live in. The drawback to a 2 to 4 family is that you have tenants. So it means that you are going to be responsible as a landlord. And so those are some things we're going to touch on a bit later in the presentation. Do note that we are discussing only 1 to 4 family homes. So if you happen to look at a property, say online, and it's a 5-unit home, 5 or more units, that nationwide and throughout the industry is going to be classified as a commercial property. And that type of property is no longer eligible for the type of home financing that we offer at UNFCU. It will require a commercial mortgage. So just keep that in mind, that if you are interested in multifamily options, limit your focus to 2 to 4 family properties. Okay, let's go to our next slide, please. And our next type of property is quite similar to a single family residence, and that's a condominium. Just as with a house, you own the physical space. The difference is with a condominium that it's in a more communal setting. Now that could be in a more suburban townhouse or golf course type community, or it could be in a giant high-rise condominium in a major city. Regardless, you own the physical space. The difference is all of the common areas within a condominium, are owned by you and the other tenants. So while you own the property, you can make renovations, again, within the confines of the condominium's rules. But I mean, you can add on or renovate, fix your bathroom, paint, whatever you'd like to do. You can rent out a condominium. You can sell it to anyone you'd like, which sounds rather rudimentary, but on our next slide, you're going to see why this is sort of important. You would have a common charge payable to the homeowners association because, as I mentioned, you own your unit, but the common areas of this condominium are paid for by you as joint tenants. So you will pay your prorated share of the upkeep of the lobby, the elevators, the tennis courts, the type of property where you're. So condominiums are very, very popular. They are found throughout the United States, particularly for someone who does not want to have the type of upkeep and maintenance as on a single family or multifamily residence. Someone who doesn't want to mow their grass or rake the leaves or paint the shutters, condominium is definitely the way to go. Let's go to our next slide. And that's going to be here we go, a co-op or cooperative apartment. This is really a horse of a different color. Co-ops are found almost exclusively in New York City and in the close suburbs to New York and in Washington, D.C. While there could be a handful of co-op buildings throughout the remainder of the country, they would be quite rare. So this really is only going to pertain to apartments in New York or in Washington, D.C. So the difference here is the building, this co-op building, has become a corporation. And you can think of the owner of that building as, it's called a sponsor. So when the sponsor is selling these units, let's say it could be a he or she or an it, but he is selling shares in the corporation that the building has become. So you're not technically buying the unit, the actual apartment. You're buying shares in the corporation the same way that you would buy shares in Coca-Cola or General Motors, or if you're lucky enough, Apple or Amazon. And ownership of those shares gives you the right to occupy the apartment. So let's go to the next slide. So you've bought these shares. What does that actually mean for you? On a day-to-day basis, it's basically the same. It's an apartment, you live there, you go in and out, you use it as your own. However, since you don't technically own the unit, you have to get approval to do a lot of different things. Because this cooperative is a corporation, there's a board of directors. And you have to get approval from the board of directors for a lot of things, meaning to make any type of renovation or alteration within the apartment, even minor or minimal changes, you would need approval from this board of directors. You would need approval from the board to ever rent the apartment. And in fact, most co-op buildings, at least in New York, don't even allow rentals, which is a big concern for you and staff members who, of course, with mobility issues, could face the possibility of having to be away for a year, but be unable to receive any type of rental income on that property. So that's a big concern for you and staff members. You also have to get board approval to sell your apartment. And this is where it sounds sort of crazy sometimes to people, but this is how it works. When you buy a co-op, you have to go through a board approval process, meaning you would interview with the members of the board. You would submit your personal and family information, financial information, and they would approve or decline you. And let's assume that they approve you with flying colors, no problem. But bear in mind that when you're ready to sell your apartment, that your buyer would have to go through the same process. And if for some reason the co-op board of directors did not approve your buyer, then you'd have to start over and look for a new buyer. So there are definitely some real nuances to owning a co-op apartment. Again, they are exclusive really to New York and Washington, D.C. We have years of experience of working in co-ops and would be happy to provide you a lot of detailed information, which you would really, really want to research before going farther into the process of considering a co-op. Okay, let's go to our next slide. So we've talked about the different types of property, single families, condos, etc. But let's talk about how you own these properties. So the most common or typical method of ownership would be a primary residence. Of course, that's what it sounds like. It's the home where you live. And because that is your primary residence, from the lender's perspective, we consider this to be a very safe type of loan. Statistical data shows that you are going to make every effort to make payments on your primary residence because this is where you and your family live. What that means is that you have more flexibility in the terms of financing a primary residence. Your down payment requirements will certainly be less or potentially less. And I'm going to discuss down payments specifically a little bit later here in this presentation. We might have a little bit more leeway on credit issues or employment stability or any of the other factors that come into play in qualifying for a mortgage. So the most flexible form of ownership is a primary residence, whether it's a single family, a condo, or a co-op, doesn't matter. Next, we have secondary or vacation homes. So a vacation home, of course, is what it sounds like. I mean, you live in Connecticut and you decide that you want to buy a condo in Florida, and that's a place that you and your family are going to use on holidays or for vacations for your own personal use. Great, that's a vacation home. At the credit union, we also consider a sort of a subgroup of homes as second homes. Let's say we have a member who has a duty station in Nairobi. And this member wants to purchase a home in New Jersey. But her duty station is in Nairobi, so that's what we consider to be her primary residence. Whether she owns or rents there does not matter. That's where she lives and works, where she goes to bed at night. So that's her primary residence. The property in New Jersey in this scenario would be a secondary residence. The terms and conditions between primary and secondary residence are almost identical. There are some minor differences, which we would of course review with you because we want to make these options, as relevant and as available as possible for our members who are living outside of the United States too, but want to purchase here. And finally, we've got investment properties. So, I mentioned earlier that investment properties can be sort of a double-edged sword. I mean, having tenants is both good and bad. It's great in that you have the income stream that comes along with this rental property. But there's also some risks with an investment property in that You could potentially lose your tenant, they move away, or you have a tenant who does not pay their rent on time, or there's damage to the property, even regular wear and tear. Those are all expenses and potentially hardships for a landlord. And listen, lots of landlords have dealt with this over the past year during the pandemic as their tenants have been unable to pay rent. Because we look at this as a slightly riskier prospect, our down payment requirements are going to be different, meaning they're going to be higher. And we're going to touch on that in just a bit. We're also going to be a little bit stricter in our review of this loan, and you may end up paying a higher interest rate and or some higher fees. And that's all because of the added risks that go along with an investment property. Okay, let's jump to our next slide, and we'll move on to the next one too. We're going to talk about the home buying process. So we know what you can buy and how you can own it. Let's talk about how you buy. The first step in this process is for you to meet with a mortgage representative at the credit union. This is really, really important because unless you're paying cash for the home that you want to purchase, you're going to need to know about your financing options. I mean, we'd all like to buy a multi-million-dollar apartment on Park Avenue, but that's simply not in the cards for most of us. And if that's the case, then you need to meet with a mortgage representative to know how much you will qualify for. Qualifying for a mortgage is really a factor of your income. Just as a quick side note, this is from my years of experience doing this. As a buyer, you will qualify for a mortgage that's equal to about 4 times your gross annual income. So if your household income is, say, $100,000, you should qualify for a mortgage loan of $400,000. That's just as a quick side note. It's not exact, it's not science, but believe me, it works. So when you have this initial meeting with a mortgage representative, you're going to be pre-qualified. This is a very, very initial step, just based on what you tell us about your income, the funds that you have available for this transaction, and what you'd like to buy. We can give you a really realistic outlay of what's going to be possible. So this is your very first, most important step: meet with a mortgage representative. Next, you're going to want to identify and find a professional real estate agent. There is so much more information available to all of us as consumers online right now, certainly more than there was 5 years ago. And 10 years ago, there was nothing. So the vast majority of buyers start their research online, and we fully assume that you will too, and you'd be crazy not to. But once you get farther along in the process and decide that you really want to, you're into the nitty gritty and you want to make offers and visit homes, you will want to work with a professional real estate agent. And I think that after I speak this afternoon, we're gonna have a break, and then you're going to hear from Lisa James, a great New York area real estate agent. And once you listen to her speak, I think you will understand the reason why it's so important to have the expertise and the experience of a seasoned professional real estate agent at your side. And finally, you'll need to select a real estate attorney. So real estate attorneys aren't used in all states, but in many states they are. We're going to talk about the responsibilities or the role of a real estate attorney a bit later. But once you've got all 3 of these lined up, so we really think of this as a team. So you've selected your mortgage lender, meaning us, right? You have selected your real estate agent and your real estate attorney. Now it's time to move forward. We've talked about a pre-qualification, but I want to touch on, with our next slide, a very important step in this process, which is a mortgage pre-approval. So the pre-qualification was really just done based on a conversation. But when you are getting ready to make an offer or to get very serious about this process, you will need something more concrete. So with a mortgage pre-approval, which again is not obligatory on our part, but it's going to be required by all the other parties involved in this process: the sellers, the real estate agents, the selling agents, the attorneys. For a pre-approval, you would actually submit a mortgage application, less any specifics for a particular property, but we would document your income, your assets, your credit, we would fully review your qualifications for this loan, and we would issue a very formal letter that says that as long as you find an acceptable property, that your financing is good. And this is really important. You know, as Ray said, it is a very competitive market out there throughout the country, with interest rates at these incredibly low levels. You know, people are telling us stories of having to, you know, shop and shop and shop to find a home. So hopefully you will have great luck, but you need to make yourself as competitive and as attractive as possible. And the best way to do that is to have a great team working with you, but also to have this mortgage pre-approval in place. Okay, let's jump to our next slide. So you've got your team in place, you've been pre-qualified, you've been pre-approved, and you've been doing your home search, and now you have found the property that you'd like to purchase. Great, that is good news. So what you'll do next is make an offer. There could be some negotiations during this phase of the process. Your real estate agent will be working with you closely, but as you agree on the price, what's going to be included with the sale, you'll come to an agreement. And ultimately, at that point, a contract of sale is going to be drafted. This document is also called a purchase agreement. So the contract of sale is the legally binding agreement that says that you're going to buy this property and the seller is going to sell you this property under these agreed upon terms. So it's legally binding. So you're all in once you've signed this contract. To even suggest that you're even that much more all in this contract, you are going to be expected to make a deposit, a contract deposit, and that is frequently called an earnest money deposit. And the amount that you pay can vary depending on where you're buying. In some states, and it's usually by state, it may be $5,000. It could be $10,000, or maybe only $1,000. But you'll be paying this money. If you're buying within the 5 boroughs of New York City, you'll be expected to make an earnest money deposit of 10% of the purchase price. So if you're buying a $450,000 apartment in New York City, you will be expected to write a check for $45,000 at the very beginning. And that money is going to be held by the seller's attorney until the time of closing. And then it's going to be credited towards your purchase. But you've got to be prepared that you're going to be putting some money on the line from the very beginning. You've signed the contract. The very important step next is to have a home inspection. This is particularly important if you are buying a single or multifamily property. So with a home inspection, you hire an inspector to go into the property and inspect all of the mechanical features of the home. What does that mean? That means the roof, the foundation, the electrical system, the plumbing, the heating. Your inspector is going to review all of that. And hopefully it all comes out perfectly. If it doesn't, you have some options. So let's say that there are some issues that you would like to have resolved before you end up purchasing the home. And you can negotiate that with the seller and get the seller may agree to make these improvements, or they credit you some money. Or, you know, sort of worst case, maybe best case, depending on how you look at it. Let's say that you find out that there are serious problems with this house and there is a $100,000 repair necessary in the foundation. You may not want to buy the house at all at this point. And as disappointing as that may be, because now you found the house that hopefully you love, you may back out of the deal altogether based on the home inspection. So this is a very important step in the process. All right, next slide, please. So now you're in contract. You would keep the process hasn't stopped. So you would be working with your mortgage team to make sure all your paperwork is up to date on our end, meaning, do you need to update your payments or your bank statements and so forth. The credit union would arrange for an appraisal to be conducted. That's different than the home inspection. The appraisal is used by us as a lender strictly to determine the property's value. It's a very important step for the loan process. If you're buying a co-op apartment or perhaps a condominium, some condos require it too, you would need to submit that board package. Remember, where you're sort of applying to be interviewed by the board of directors, and your real estate agent would assist you with that. Your attorney would be doing his or her work at this point too. So that's what we mean by review title. So one of the things that you're paying your attorney to do is review all of the legal background on this home to make sure that the home can be sold to you free of any types of liens or judgments, that you can take clear title to the property, that the seller has the legal right to sell you this property. All of that sounds rather mundane, but it's actually very, very important. And all of these different processes are going to dovetail into what's called the closing. So the closing is that day where all of the various parties meet, and the legal documents are executed, and the ownership of the property changes hands, the monies change hands, and you walk away with the keys. So that's the closing, and that's the the end point of all this. And a question, of course, is how long will all of this have taken? And it really depends on where and what you're buying. In general, you should count on 45 to 60 days for closing to take place. Now, in some parts of the country, let's say you're buying in the Washington, D.C. area or in California, the expectation will be for the closing to go much faster, and you could be looking at 30 days or maybe at the most 45. On the other hand, if you're buying in New York City and it's a co-op apartment or even a condominium, you could really look at a longer process. It may be more like 60 to 90 days. Really, 90 days is not that uncommon for a co-op apartment. So there we've looked at this process from start to finish. And I hope that helps you understand what's going to be taking place when and who's going to be responsible for it. So next, we're going to talk about, next slide is our U.S. mortgage terms. And let's go ahead and jump to the next slide. And we're talking about budgeting. And I had mentioned earlier down payment. So down payment is that portion of the purchase price that you're paying out of your own funds. Ideally, a down payment would be 20% of the purchase price, and that sort of random number is used industry-wide, because if you make at least a 20% down payment, which is a lot of money, but you could avoid some additional forms of insurance. It is certainly possible to make or to purchase a home with less than 20% down payment. In fact, you could buy a home with as little as 5% down payment. This added insurance would apply. But it's a great means to an end in terms of buying a home before you have this huge amount of down payment money. Remember when I mentioned for investment properties that you may need a larger down payment, and that's where this 30% figure comes in, because again, for the somewhat riskier investment property, we're going to look for for down payment funds in the 25 to 30% range. Now, in addition to that down payment money, you're going to need to have money saved for your closing fees. And the closing fees on a mortgage loan or on a purchase can vary a lot. Just like the time to close can vary, so can the closing fees. And again, it depends on where you're buying. Some of the highest closing fees in the country are in New York City and New York State in general. California has high closing fees. Maryland does. In comparison, a state like New Jersey or Connecticut has, comparatively low closing fees. In general, you should count, and of course, we can give you all of this information as you're narrowing your search, but your closing fees should range somewhere between 2 and 5% of the loan amount. It's a big range. But let's say you're taking out a $400,000 mortgage in the 5 boroughs of New York City. Your closing fees could easily be $20,000, if not even a bit more. In New Jersey, those closing fees may be $5,000. Still a lot of money either way, but you can plan for it. Just at the bottom of this particular screen, you'll see what's ultimately a link to a calculator, the mortgage calculator on our website. And this is a really great tool to use. You can go into this calculator and you select that you want to get a custom rate quote. Plug in the information for the type of property, where it is, the purchase price, the loan amount, and you can make these changes 100 different times if you want to. And our system will calculate not only our current interest rates and the applicable payments, but also the closing fees that would be due for the particular, it's down to the municipal level of where you're buying. So that's a great tool to use, particularly if you're starting your online search. You want to think about, what would payments be, what would closing fees be. This is a great place for you to look into that. Okay, we got to move on. Let's jump over to the next slide, which is for fixed rate mortgages. Fixed rate mortgages are exactly what they sound like. You take out a mortgage loan for anywhere from 10 to 30 years, and the interest rate remains unchanged for the life of the loan. So there's a lot of security, of course, or stability in a fixed rate mortgage. So for a buyer, a member who is buying a home with the plans to stay in this property for many years, the stability of a fixed rate mortgage is probably really, really attractive. Now, you are going to pay a slightly higher interest rate for the benefit of getting a fixed rate mortgage, but for, again, long-term horizon of ownership in a property would make a fixed rate mortgage quite attractive. Let's jump to the next slide, which is adjustable rate mortgages, this is also called an ARM. You'll frequently see this referred to as an ARM. So with an adjustable rate mortgage, you also have a 30-year loan. Now, we do offer shorter mortgages, but the vast majority of purchase loans are issued for 30 years. The longer term gives you a lower monthly payment, which of course is attractive. It allows you to qualify for a higher loan amount. It does mean that you're paying us more interest in the long term. So if you are comfortable with a shorter term payment, it will save you money. That said, again, the vast majority of loans are issued for 30 years. But with an adjustable rate mortgage, the difference is your rate isn't fixed for the whole 30 years. Your rate will be fixed for an initial period, the first 5 years, or the first 7 years, or the first 10 years. The benefit is that for that initial fixed period, you're going to get a lower, and in some cases, much lower interest rate than what you would receive on a fixed rate mortgage. So for one of our members who is buying a home that they don't plan to live in forever, and listen, that is very, very frequent with our UN staff members who plan to be in a New York duty station for 5-6 years and then move on to Geneva or wherever it may be. An adjustable rate mortgage is a great option. So for the time that you do plan to have this home, your rate's going to be lower and you're going to pay us less each month. An adjustable rate mortgage is also a good option for someone who's looking to maximize the amount of money that they can borrow. The lower interest rate and lower payment allow you to qualify for a larger loan amount. So there are inherent risks in adjustable rate mortgages, but it's something to consider, and they are a really good opportunity for the right person. Okay, let's go on to our next slide, and we'll go one more slide, please. And that is specific to us here at UNFCU, and how can we help you? I would say that, with pride, we have served our core UN members for over 70 years now. And that long experience of working for many years exclusively with UN staff members gives us a really deep understanding of how your employment works, what types of documents you have or that you don't have. We know what a G4 visa is. We know that they expire if you're not traveling outside of the country. We understand that you're not going to have tax returns or W-2 forms, which are, most US buyers have these documents, and maybe not even a social security number. And that's all okay for us. We do know what a personnel action form is, and we do know what post-adjustment and dependency allowances are. So all of these issues that are very unique to the UN community, that's all we do. So just not having to read, explain, or reinvent the wheel when you're going in to apply for a mortgage, I think that alone is a real benefit. I'm going to jump down to the bottom item here, this U.S. credit profile or history not required, because it's sort of related to the issue of UN practices. Listen, we know that some of our members don't have a social security number, do not have a credit profile or a credit score, or maybe they have a sort of low credit score, not because of bad credit, but just because they have limited credit. We're fine with all of that. And you would just have a blank stare if you walked into most commercial mortgage lenders in the United States and said that you didn't have a credit score. We're very familiar with it. We know all of the tricks of the trade to work around this issue. Not only can we work around the issue for the purchase of this property with you, but we can also help you establish your credit profile. And if you're going to be in the United States for a while, this is important. And we're happy to help you with, again, many, many years of experience working with you and staff people on how to establish your credit. We know that buying a home is difficult for anybody, anywhere. Listen, it's not an easy process. We want to make it as easy as possible. We understand that it's complicated even more for most of our members, or for a lot of our members, because not only may they be buying their first home, it's in another country. So we really understand the need for a close relationship between the mortgage team at the credit union and you. And, when it says that we're going to be with you every step of the way, and I believe that our member in the video at the beginning referenced this specifically with Sophie, that she was with her every single step of the way. And that's what made the process so successful for her. We're going to try to offer that for every single member who comes through the door. And finally, I would say also, look, we're a credit union. We're ultimately a nonprofit organization. So instead of paying dividends to shareholders, we put that money back into the credit union, which means, we try to offer rates as low as possible. We certainly are not looking to make a lot of fee income off of our members. So we keep fees at a minimum, particularly in comparison to commercial banks. So, all of that said, we've got a long-term close relationship with our UN members. We hope that you'll come and speak with us, and that we can help you through the home buying process. In fact, on the next slide, here is our team. These are the mortgage representatives and loan officers who work almost exclusively with UN and UN umbrella organization members. This is a great group of folks, and they do an excellent job. As Ray mentioned, these particular teams are based in New York City and Washington, D.C. Please use this link and schedule an appointment. We would love to have the opportunity to meet with you. And I know I've gone really fast, but I think that we probably have some questions. So I believe at this point that Sylvia is going to join me and let me know how she's going to grill me with questions.
Yes, Chip, thank you. I mean, that information was just stratospherically helpful. I mean, even just thinking just from my own experience, which I would wish I would have sat through something like this prior to my first home purchase. I mean, just looking even, I probably would have benefited from some type of checklist because I totally missed the walkthrough. But with that said, we do have lots of questions. They're coming in strong. So in no particular order, here we go. Ready?
Sure.
So how do interest rates at UNSCU compare to that, to what's being offered by U.S. banks or mortgage firms? So how do our rates compare in the industry?
Look, I would say that our interest rates are very competitive. I'm never going to say, oh, we have the lowest rate in the market. And any lender who does make that claim, I don't know, they're either foolish or foolhardy, because there's always going to be a lender somewhere that might be able to beat you on rate. As I mentioned, our goal is to offer, very competitive products to our members in terms of rate and in terms of fees. This may not make a lot of difference, but we keep a lot of our mortgages in our own portfolio. meaning we make our loans to our members using our members' money, and we keep the loans here at UNFCU, which gives us some greater flexibility, say, on adjustable rate products, which have always been very, very popular with our UN staff members. So I would say we've got competitive rates. Shop with us anytime, and we would be happy to compare anything that a member may have from another lender.
Excellent. That's great to hear that you're open to that. Great. So next up, understanding that there is a membership that needs to be obtained with UNFCU. So how soon can an individual apply for a UNFCU mortgage for an investment property after becoming a member?
There's no restriction. So regardless of the type of property, there is no restriction on length of membership before a member can apply. And in fact, our rules have changed. A member or someone who's not yet a member can apply for a mortgage loan and open up their membership account during the processing of the mortgage. So there's no requirement for any length of membership before applying for a mortgage loan. Great question, but we're ready to start as soon as you are, and then we would assist with getting the membership account opened.
Okay, so it sounds like there's some flexibility there. Good. What about some first-time homeowners incentive? It was like a part 2 to that question. So considering this will be their first mortgage with us, are there any types of incentives?
Yes and no. So the credit union was just in the process of rolling out a really attractive new first-time home buyers program just before the whole pandemic struck. And so, of course, that got shelved for a bit. But it is going to be coming back into play. We are hoping. I have meetings about it with my boss, Ray, and other members of the whole mortgage team. We're hoping that we will have that up and running at, say, maybe third quarter. No promises, but that's what we're hoping for. There will be some different benefits. There may be the opportunity to make an even lower down payment. So maybe a 3% down payment as opposed to a 5% down payment. The credit union has always offered some amounts of credits available toward closing fees for first-time home buyers. So that's never gone out of duty. So we still have those available. Mainly for first-time home buyer programs, it's related to down payment. And we hope to have a first-time home buyer new program up and running later this year.
All right, looking forward to those programs. You did talk a little bit about those members that reside outside of the U.S. So here we have a question. Can the member be eligible for mortgages holding a G1 visa working at a permanent mission to the UN?
Yes. So some years ago, the credit union began opening up membership to permanent missions. So almost all of the permanent missions to the UN around New York have opened up accounts at the credit union. And once the mission has, then all of their staff members become eligible to apply for mortgages, even with the G1 visa. The diplomatic visa, in this particular case, for someone who works at a mission, is eligible. There are some restrictions that mainly has to do, again, with down payment, which of course is the song that I keep coming back to, down payment issues. Typically, the main difference for a G1 visa holder or mission staff person would be a minimum of a 20% down payment. That being said, everything else is available.
All right, great. You nailed part 2 of that question. That was coming up strong with what would the down payment look like? So thank you for that. So next up, I know you covered a little bit of comparison with why UNFCU. So the question has come up, if we can just talk a little bit more about that, on what the advantages are that a member would have by seeking a mortgage here with us, as opposed to going to a commercial bank.
Well, I mean, we're a credit union, so we have always been very service driven. And, you know, our staff are measured on a monthly basis, somewhat on how much business they bring in, but even more so on the service levels that they provide to our members, which is pretty unique. You know, hey, my sister happens to work for Quicken Mortgages, and you never meet a person. It's whether by phone or it's all done electronically. And for some people, that's great. A lot of our members really prefer to have the one-on-one service with a mortgage representative who would be working with them from day one all the way to closing, just like Sophie was in the video that we saw at the beginning of this of today's event. So again, hey, rates and fees, those are all great, but you know, what's really important is finding a lender who is, one, going to make the deal actually work, and not be full of a lot of promises, but actually come through on everything that we've said that we can deliver, and with a great level of service. That's what we really pride ourselves on, is the service level that we provide to our membership.
Definitely serving the people that serve the world. Excellent.
Exactly. There it is. There's our motto.
Exactly. So you did say, you know, that some companies do run virtually, and given the scenario that we're in today, in the state of this pandemic, can the majority of the closing process be done virtually now?
It really depends on the state and even the municipality. So I'll make a long story quite short, but mortgage closings have been very, very slow prior to the pandemic in keeping up with technology. I mean, we were still, and this is everybody, all lenders throughout the country, very, very old school, with people meeting in person, signing papers, pen on paper. That is changing very, very rapidly. And so if a state or if a municipality will allow either e-closings, we are allowed to do it. There are some that do a type of hybrid closings. So this is moving very, very quickly. It's a fluid situation. We get updates, honestly, every week from our closing department about where we are now offering e-closings. I would tell you that one of the slowest states in the country, and this is based on the state, not on us, is New York, unfortunately. They are slowly catching up, but some other areas, especially around the DC area, California, really took this and ran with it. So we will all get there, but right now it will depend on where you're buying and what is allowed locally in terms of remote or electronic closings.
All right, good. Definitely a step in the right direction. Make everybody feel safe and comfortable. So here's a question. Is it possible to refinance under a fixed rate mortgage if a lower interest rate is available down the line?
So I guess the question is, if someone has a fixed rate mortgage and then later on interest rates drop, can that member refinance to a lower interest rate? Absolutely. So not only we've got some great opportunities for people who actually have mortgages with us. So we've always had refinance options, and that is the right loan structure in many cases. But we also have a very, very active interest rate modification program that we have run millions of dollars worth of mortgage loans, and hundreds of our members have taken advantage of this, where you simply pay a fee and we drop the interest rate from whatever your current rate is to what our active rates are. And with interest rates having been so low, they have inched up very slightly, but they're still incredibly low. Again, hundreds of our members have taken advantage of this really great program. So two options for someone who has a mortgage: mortgage refinance and an interest rate modification. Both should be explored.
All right, great. It's great to hear that there are options there. And even if it is a fixed and you're locked in for that extended term, that you do have alternatives. All right, we had time for one last question. This goes back to when you were talking about those pre-approvals, pre-qualifications. So how long are those approvals valid for?
Great question, and it comes up very frequently. A pre-qualification really does not have any type of expiration because we're not basing it on any hard documents, but a pre-approval does. A pre-approval typically is issued for 120 days. And the reason for that particular limit is that is how long a credit report is valid. So as part of a pre-approval application, we would obtain your credit report. We would get bank statements and pay statements also, and those can very easily just be updated. But the credit report itself would expire after 120 days. We can just run a new credit report and basically grant a new 120-day period. But initially, or at the outset, the pre-approval will be good for 4 months or 120 days.
Got it. 120 days. Excellent. Well, thank you, Chip. That was lots of good tips and best practices, very informative and informational for us. Thank you for taking the time to spend with us today.